Hi, I'm Lynn Adams.
I'm Justin Gross.
Thank you for joining us for our fourth quarter conference call in this edition of Video Insight. Everything we talk about on this call today is really for informational purposes only, and nothing here that we're going to speak about is intended to be investment advice. So we really want to start off the call today just talking a little bit about where the markets are as of the end of the third quarter. This has actually been a pretty good run for every sector, and I would say that it's interesting because last year was a pretty bad year, so we had a bit of a bounce, and despite the volatility and the lack of direction in terms of the global economy, we still see a lot of sectors bouncing to new highs and also having quite a bit of volatility at the same time.
Yeah, we always talk about reversion to the mean. We talk about it all the time, and you remember the fourth quarter of last year was pretty bad. So these numbers are a little bit misleading from a time perspective because we pick up January 1, not December 1, as we've talked about in the past. So, and longer term, which we'll talk about as well, I mean, since 2008, January of 2008, markets are barely positive, and sometimes these numbers can skew that, miss that point.
Right, so for those of you that had the handout, or if you're watching on the video, just run through them. Real estate, year to date, up 28.5%, right? That's pretty impressive, but it's leveraged, it's benefiting by severely lower interest rates, and it was also a bad year last year. U.S. large cap stocks, S&P 500 is up 20.6% through the end of the third quarter. Again, that sounds like a great situation, but you got to look at how much it lost last year. U.S. small cap stocks, Russell 2000 was down last year as well, but this year's up 14.2%. International markets up this year, 13.3%, bouncing as well. The real, if you could highlight one piece here that's really noteworthy, is the bond market. The bond index is being up 8.5%. That is, that's a very unusual event. That doesn't happen when yields are at 1 or 2%. So that's actually such a dramatic short-term return. We're actually taking profits in a lot of our portfolios and reducing some of the bond exposure because we want to lock in on that unusually high gain.
It's not the biggest number total return-wise on the page, but it's probably the biggest shock and the most unexpected and to the upside.
Correct.
So that's really good.
And because of that, again, reversion to the mean tells us that when the cycle changes, that actually has the furthest it could fall back to revert to its 5-year mean or 3-year mean.
Which brings in a psychological component because that's not why you buy bonds, right? So taking profits there is a good thing.
Yeah. Emerging markets still trying to find their way out of a very, very difficult environment. They're up 6% this year, and commodities were up 3%. So that's sort of the big picture on the broad market numbers through the end of the third quarter. We're now a couple days into the fourth quarter, and we have seen some pullbacks and volatility. And I really want to talk about that here, and I will in a moment. But in the meantime, let's just look real quick at valuation. So this chart shows the S&P 500 as of the end of the third quarter. And what we see is that it's selling at 16.7 times earnings. And we know that long-term, price to earnings ratio, it doesn't tell the whole story, but it is a good barometer of real value. And at 16.7 times earnings, it's kind of right in the middle of the long-term ranges where stocks should be selling at. I don't see anything here that says, oh, these are super cheap, we should be buying more than normal, and I don't think that we're so expensive that we should be taking profits because they're too high.
But the duration of this upcycle has been lengthy, but hasn't really resulted in a
excessive valuations.
Right. That's right.
So let's talk about this current trend. This is the first time I've done a slide like this. What I've done is I'm charting here really the last 3 years. I want to try to illustrate a point. So the purple lines represent the range that we've seen most of the trading take place with the S&P 500. And there are a few I guess moments where it breaks out the upside or downside, but for the most part, these two lines show the trend growth that we're in. If you were to measure it, it's about 2.5% per year of trend growth, okay? But I want to talk about the nature of the market for a moment and how it affects day-to-day, how headlines affect day-to-day trade. So if you go back and look at this first section that I've highlighted back from 2017 to 2018, that entire period of time, once Trump got named, elected, whatnot, and they got Congress working on the stimulus bill, that entire period of time market was really racing upwards because of the implications of the stimulus bill that was passed. All of corporate America got a 20% tax cut. So that instantly impacted earnings to the upside. Shortly after that, President Trump started discussing, trade relations and how things with China and the U.S. aren't favorable for us over the long run. And as those conversations took place, we saw the market slip down to a lower part of this trading range. And then shortly thereafter that, around July of 18, corporate earnings came out, consumer spending data came out, and we raced right back up to the top of this trend, up to new highs, because corporate earnings ultimately are what people are buying when they buy stocks. And then on the heels of that news, last fall, two things happened. We kind of had a double punch, right? One is that the trade talks became escalated, the tariffs went into place, the first round of them, and at the same time, the Federal Reserve said, the economy is growing so strong, let's take this opportunity to raise rates and try to get some more dry powder in their arsenal of things they can use to stimulate the economy at a later date if they need to. So you had two things happen, and it pushed the market actually down below the trading range briefly. But then, you get to Christmas earnings, and you get into the beginning of 2019, and the consumer and the incredible spending and the consistency and the resiliency of the consumer pushes right back up to this top of this trading range. And then Trump and China have some bad words with each other, gets the market all shook up, drops back down. Next thing you know, Fed lowers rates, it goes back up to the top of the trend. But what I want to illustrate here is we're in a trend, right? And it's a predictable, to some degree, trend. It's about what is the real economy capable of growing at in terms of pace. And when we get ahead of ourselves, there's a natural pull of the market to pull us back into where we should be. And when we get below where we should be, there's a natural pull of the market to pull us back up to where we should be based on organic growth. If you track this,
a lot of these turning points in this trend are, I would call them almost knee-jerk, because it's headline shock, and it's media driven, and it's, oh my goodness, it's reactionary. You got to do something. So a lot of these are turning on a dime, so to speak. But
and that's where people can get hurt.
Yep.
Because they see it and they go, oh, I need to get out, and they sell it while it's down, or when it's going up, and they feel great about it. Like, oh, I got some extra money. Let's put it in because things are so well. Yep. But look at the next slide. So if you take this recent trend, the two purple lines, and you track them all the way back into, a longer bit of history, you'll see that where we're at right now is actually in the same trend that we were at after the technology bust. From 2000 to 2008, before the banking crisis, we were in this trend. And it's a slower growth trend than we had in the 90s. And because it's never got back to that boom time atmosphere, there's been a lot of naysayers. I mean, constantly, oh, it's never going to be like it was. It's not as good as it was. And that's an accurate statement, but it doesn't mean that it's bad. And it doesn't mean that it's going to turn and fall off the cliff. Now, in this chart, you will see in 2008, when the banking system got over leveraged and the government had to come in and support a lot of banks, and a lot of big banks went out of business, it took 5 years to get that really stabilized and dealt with. But I think we're probably back into this long-term slow growth trend, and we just got to be okay with that normal volatility that comes with it.
On one point here, because I don't know that we're going to touch on it specifically, but if 2008, everybody remembers 2008, it probably won't be the same things next time that it was that time that caused that, but simply having a plan in place to help protect against whatever the next one is,
right,
can be a big deal for your returns to separate from the market.
That's right. There's only one last slide in regards to this trend pattern. It's even a longer view, taking you back into the early 90s. And I just wanted to put that in to illustrate we're not on the trend path that we were in long term. Like if you include the 80s and 90s, that was when they created the internet, and you created networking computers. You created a lot of advances in 2G to 3G, and a lot of amazing technology that really impacts corporate efficiency in our daily lives. So we're not going to be in that trend pattern, but we do think we're in a more stable 2 to 3% GDP range going forward. And when you take that and you add a dividend of 2.5%, 3% from stocks, I think that paints a picture going forward that we probably would expect something between 4 and 6% returns for stock investments. I mean, that's trend.
Yeah, trend. And standing here today, we don't know what technology is going to be here 10
right.
to 15, so maybe there's surprises to the upside, but
right.
we can handle those.
That's right. So let's talk about how long this bull market is. A historic year, right? We've now reached 123 months of the market and the economy moving forward. That's the longest bull market in history, right? That's great. It's been an amazing journey to be a part of that, working in this industry. But the flip side is the chart on the right. It has been the longest duration, but the total return for investors from the beginning of this 123 months to date is the blue line on the far right. And you'll see that even though it's the most lengthy expansion, it's not brought the returns as the other 6 other economic expansions that have been recorded in the last 100 years, right? So it's a slower but more lengthier expansion. And for that reason, because it's slow, I think it can be sustained for much longer because prices haven't become excessive.
It hasn't gotten ahead of itself from a return standpoint. Yes, lengthy, and that's where there's a disconnect. Well, it's gone too long.
Right.
Long that's one factor, but it valuation and.
Right. And if I could get $1 for every time I hear somebody say we're late cycle, we could be rich. I mean, that's because everybody says we're late cycle, we're late cycle, we're late cycle, but compared to what? Because there's no other cycle that has grown this slowly.
We've been late cycle for a long time.
Right. All right, switching gears, let's look at another couple pieces of information. Corporate earnings. So this is what the analysts are projecting for U.S. S&P 500 companies for the next year. You can see still trending upward with earnings projections, and there's not a lot of reasons to believe that U.S. corporations won't have this level of corporate earnings in the next year. The margins, not just the earnings, but the margins at 11.4% as the S&P 500 average corporate earnings, those are pretty good margins. It's nowhere near the margin decay that we've seen in the recession that took place in 01, 02, or 7, 8, and 9. We're substantially higher than that with margins. Switching to the other side, sort of the other side of the coin is, well, what are we going to do about this slowing global growth? This heat map here shows you really the world is manufacturing less stuff. And it is, in some places, is becoming very alarming. I think that we have to question, well, how big is a manufacturing slowdown or a manufacturing recession? How does that kind of compete against a very resilient and strong U.S. consumer and a very lean and mean corporate America that is holding good margins and still growing earnings a little bit each year? I mean, it's a big tug of war as to what's going to drive the market, but we have to note, hey, this is a red flag.
It's a factor.
Right. Looking at the consumer, so if the consumption of our U.S. population is really the bright spot, let's look at the health of that consumer. One of the things here on the right-hand side of this chart I think is really, really noteworthy is the average household debt service ratio is 9.7%. So out of the average income that a household brings in, only 9.7% of that income is going to pay down debt. That is the lowest percentage of income going to deal with debt that we've ever recorded in my lifetime. And I think that's really important for people to keep in mind, because you hear a lot of discussions about, well, there's a lot of student loan debt and there's a lot of government debt and this, that, and the other. And those are real concerns, but in the consumption sector, in our culture, in our households, the debt is not an issue, right? And in fact, our net worth, household net worth, is also at an all-time high as well as of the end of the third quarter. So these are things that give us reason to believe the consumer can still be the shining spot for the global economy.
And that frees up assets for further consumption, for spending, which is all good for publicly owned stocks.
Right. And if people today want to go buy, a big ticket item, interest rates are so low that they're actually tempted, even though they might have the money, to just borrow because it's cheap money. In fact, this next slide shows globally, if you look at all of the governments around the world and the current interest rates that their notes are selling at, about 1/3 of government-issued debt all around the world is actually paying you to borrow money. It's negative interest rates. Now that's really unusual, right? And then another third, the cost to borrow money is less than 1%. And there's about another third here in the gray that it does actually cost more than 1%. In the U.S., 10-year Treasury is at 1.68. But here in the American economy, we're not only strong, but we're charging the most interest for people to borrow money than anywhere else in the world. So there's plenty of access to capital, and there's plenty of reason to believe that people can take the capital and grow if they want. But in the U.S., the household debt numbers show us that people aren't really taking on the debt. They don't need it.
Right.
So those are just some interesting things. But we see global interest rates this low as a positive for the world economy. So to just summarize what we talked about today, it is a milestone that we're in the longest bull market in history. I think that's great. I'm excited that we've been able to be a part of it. I think that it is not safe to say that this is late cycle. It certainly could be, and we could have something happen tomorrow and the economy get derailed and our portfolios are positioned to manage that risk. But at the same time, because the rate of return has been so slow during this 123 months, it is a sustainable upward trend. So we need to be careful that when we see a headline event occur and the market sells off 3 or 4 or 5%, that we don't process that even on a subconscious level that, this is the beginning of the next bad thing, the banking crisis or the dot-com crash or the next war, because that's our instinct to feel that way, but the data doesn't suggest that that's really where we're at.
Yeah, be prepared to defend yourself, and we are, but don't do anything drastic because it can create the ball rolling downhill of bad decisions.
Yes.
Right? If it goes down and you make a move to get out, and it goes down, you get like a confirmation, right, of I was right. Then if it continues to go up, you anchor to that. So
Right.
it's
Right.
a tough thing.
The one thing that we are most concerned about, I think, is global manufacturing. We're trying to be conscious of our decisions and our portfolio weights to stay away from regions that are impacted by that. But overall, we think we're kind of in a trading range, trending slightly positive. So sort of to conclude, I think we're going to stay in a low interest rate environment. I think that in the U.S., the economic expansion from here will be very, very slow paced, not only because of manufacturing, but I think there is some political influence. I think that companies don't want to spend the money to invest, so capital spending, until there's clarity as to who's going to be in the White House a year and a half from now, and what is the situation with China and trade going to be. If people believed, for example, and it was clear that, say, President Trump was going to remain in office for the next 5 years, right, get another term, and if China and his administration would agree, I think you would see corporations say, well, we're going to make a bet and invest some capital in doing some things differently to capitalize on that outcome, right? But if you get a different leader and the whole China-U.S. trade decision evaporates because a different leader says this is just a big waste of time, again, I'm not making that call, but another leader might feel that way, then businesses would say, well, gee, I'm glad I didn't invest that money to benefit from the first scenario. I'd rather wait. So I think businesses are now starting to hold back on their spending in order to see what is really going to happen. So with slower corporate spending, a slow manufacturing, that's reason to believe we're not going to move forward quickly, right? But on the big picture, the millennials are starting to really make some good money in replacing boomers that left the economy in retirement. Those ratios are good, earnings are good, prices aren't too high, so I would say we're cautiously optimistic here.
I think that's a good way to describe it.
All right, so with that, we'll wrap up. Feel free to send us any questions by email or reach out and call us if you have any questions or concerns about how this might affect how we're positioning your portfolio. We appreciate the opportunity, as always, to serve you and your family, and with that, we'll run through the required disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 Index is an unmanaged index representing the largest 500 companies in the U.S. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in these indices. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and fees and expenses associated with investing. Past performance does not guarantee future results.